The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and the Tech Insider, David White.
And welcome all to another beautiful day here at TFNN.com, the headquarters for technical trading and investing. And we've got a market out here that wants to go higher, but just doesn't have much since about 10 o'clock. This thing's been trading at about a 1-point range. We've got 2.2 billion shares on the consolidated New York Stock Exchange tape. You'd really like to see this thing have a volume come in as a sign of strength, but so far a fairly average day in the volume department. Of course, we are above previous highs out here. Seeing some movement in some stocks. Apple is up about 6 points, 427, a little under 8 million shares. So what do we got out here? It's kind of hard to tell. We had Ben Bernanke basically come out last night and say, you know what I said last month, just kind of disregard that. There's not going to be anything coming anytime soon. And when it does, I'm going to tell you about it, but you won't believe it anyway because I've lied before. So we've got Gentle Ben, who is now the boy who cried wolf, and talking about dropping some of the issues back here. And by the issues, I mean lower interest rates and, of course, a stronger dollar. And most of the things that were happening just 2 days ago, he basically waved his hand and decided that, nah, we're pretty much going to go back and do what we were doing before, and it's pretty much all or nothing. If we've got $4 trillion on our balance sheets right now, we're going to go to $8 trillion. It doesn't matter. Whatever it takes is what it's going to be. And unfortunately, the problem is very much like the pilots. Oh, would you stop that? Oh boy, we've got this new little 8-week-old or 9-week-old puppy here. Just does not like to be left alone very long. And right now she's playing with the other trading dog. And normally they sleep this time of day. Not exactly sure what the deal is. Anyway, we've got some interesting movement out here. But the problem is much like the pilots found out on what it was Sunday. And that was they found themselves low and slow coming into a landing. And one of the problems that you actually get is is a problem that's known as getting behind the power curve. Any pilot that got his license was basically told, well, let's get up here fairly high so we don't crash like the plane did on Sunday. But I'm going to tell you what to do. We're going to just keep pulling back on the stick and get the nose on this airplane higher and higher. And at the same time, we're going to continue adding a little bit more power, But at one point, no matter what you pull, how much you pull back on the stick, you can't add any more power, and the airplane stalls. That's exactly what happened on Sunday. You could see that the nose of the airplane lifted very high. Eventually, the air just tumbles over the wing instead of creates lift, and you stall. Now, the problem with Ben is that he's basically committed to full power here, and he's going to continue to pull on the stick back. Eventually, at some point, maybe it's 5 years or 10 years down the line, maybe this works. But in my experience and reading probably about 10 different books about the stock bubbles and market bubbles in the past, the idea has always been that someone is smarter than the markets, and it's always ended the exact same way. Probably the closest thing to the belief now is the long-term capital management fiasco of 1998. They basically believed if they could continue to leverage it, there was no way that they could actually ever get priced out of the marketplace. And of course, were at 100 at one time 100 to 1. Every dollar they had $100 worth of bonds. And a lot of these bonds were worthless things. They were from Mexico, and what really got them in trouble with when the bonds blew up in Russia. But the idea that you can continually push and push and push eventually hits a place where either the market or a country stalls. And we've had Ben Bernanke, I think, seeing what happened in the last 2 weeks. Oil prices going drastically up. Probably going to see $4.50 gas across most of the country here in the coming weeks. What is he going to do? And basically, you know what I said on June 22nd? I'm just a big fat liar. We're not going to be doing anything. I'm pretty much committed to 2% Fed fund rates, and we're going to do the rest. And don't really bring up what I said last month. So what does that mean? That means he's committed in it, in for a penny, in for a pound. The only thing that I see is he had an excellent opportunity to let some of the steam off the market that he's created. And, of course, you can't throw this kind of money in a market without causing some problems. That's what he was talking about just on June 22nd. There were major problems in the stock market, and starting to see subprime loans come back. All the things that got us into this problem, or into these problems, were coming back on June 22nd. So the market pulled back a little bit. Everybody started to squeal, and you know what? We decided to create yet another bubble. So actually wrote in my newsletter this morning how much this was like in late 2001. I think it was probably September or October of 2001. Tom O'Brien and I were sitting down in Beef O'Brady's having some wings at lunch. We were talking about he'd been at least through two real estate cycles in Boston where the markets pretty much had a issue. Came back, and we were talking about it and debating what was going to be the problem. And he basically said, well, it's going to be all this cheap money. And I thought, well, I was thinking more locally. In Florida, it was going to be insurance rates. I'd seen my insurance rates go from about $4,000 a year to about $8,000 a year in 3 short years. And I thought, you know what, that's going to be probably what busts the markets out there is insurance. And, of course, I really didn't think that far through that it was because I was on the waterfront, that I was on, basically 5 feet away from the ocean. And it had more to do with the Hurricane Charles coming in to the Fort Myers area than anything else. But we cracked here in about 2004 and a half, 2000. Well, it was late 2004. I think it was August 13th, 2004. Charles came in, and within 3 months, the housing market started to have major malfunctions, mostly because of the lack of insurance in it. And it wasn't the housing market per se, or mostly the loans. It was the fact that you couldn't get insurance and you couldn't resell your home. And this was Florida was ground zero for this happening, at least the start of the collapse of the housing market. So as we continue to see what Ben Bernanke is planning, the question is, how does he extract himself out of a market in which he's basically taken all the chips in front of him and pushed them to the center of the table today or yesterday and said, I'm all in. Doesn't matter if it takes $400 trillion. I'm just going to continue pumping money in every single quarter. Now, eventually that money has to come back out. So is it any different than taking a bucket of water from the deep end of the pool and taking it and pouring it in the shallow end? In the end, it's not. We're going to have to pay that back at some point, but the idea is to keep the velocity of money moving and don't have a market lock up. Now, the question is, what happens if he does all this stuff and we see China and Europe continue to implode? Basically what we saw on Sunday. You're going to have a market stall, and it's going to be 10 times worse than letting off of the energy right now. But just like in late 2001, Tom and I were talking about the housing crisis. It took a full 6 years of excesses before it blew up in everybody's faces. We can probably all, I don't know if all, but I'm going to say most people that I would think intelligent knows that there will be a day of reckoning. Will it be 7 years away from now? It could be. We have basically two options today. One, we pull back, close lower than the previous high. Or two, we see this kind of low volume movement continue as long as he continues to pump money back into the market. The longer he does it, the more I think that Tom O'Brien's call of a 850 point S&P test is probably more likely. The more that you distort a market, the more it will blow up in your face when it comes back. I think we saw some of that in gold. No one probably really thought that $1,200 in gold was reasonable when it was pressing 1,900. No way that it was going to come back. We're going to continue to spend money, but it did happen, and we could see easily that or more if the wheels fall off the wagon of world markets, especially China, which could have a huge banking problem. So in my thoughts out here, we're probably going to close slightly higher today. Volume is not going to be much, and we could see these kind of incredibly light volume markets move higher for an incredibly long time. I would not be surprised if we do have any kind of volume come in before the end of the day, that we see over the next 3, 6, 9 months a bubble of biblical proportions. As long as he continues to slam money in, it's going to have a disproportionate effect in the markets, especially with light volume. We're going to see stocks like Netflix go from $50 to $250 to $280, and maybe this is the time to get in on it. Just be very aware that there will be a day of reckoning. And at that point, you want to be able to get out of your cash and walk away because there will be a major market event, and it's happened every single time in recorded history. So probably not a whole lot to say more than that. That is that we don't have a market that can support it. We have earnings headed down. Everything says the market should head lower. The only thing that makes this market go higher is the Fed pushing cash and basically everybody trying to find a seat to put that cash that will actually make them some money. And the thought of leaving that cash out there and maybe having high inflation coming is the specter that everybody doesn't want to have. We've got to be making money now because everybody knows the merry-go-round will stop one day. We'll come back in a minute. Give me a call, 877-927-6648.
The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
And yesterday we were talking to Larry in Wyoming. Maybe he'll call in today and tell us what he did. But he had puts on Angie's list. This is one of the ones that was hanging out here on very light volume. Even on a day where we are breaking out highs, there are more stocks out here than ever breaking highs and coming back into the trading range on the lighter volume. Angie's list was a pretty good example of what we'd seen out here. I suspected this thing had a good chance to come back to the $21.50 level. If it showed a little bit more weakness today. Volume's actually fairly decent out here, but this thing is getting ready to come into earnings, and you are in, basically looking at maybe at the bottom of this candle. It did come up on high volume on 424. What is that? April 25th on 7 million shares, and it's kind of back into that candle now. Unfortunately, the market is going against this trade, but not a bad deal out here. But maybe going to need some more volume to get back down to that 2150 level. What you did see is what I like, and that is just infinitesimally light a volume above previous highs. In this case, 7 million shares, and the July 5th high, 468,000 shares. The 8th high, 660,000 shares. 666,000. Maybe I should just say mark of the devil, 1,000. Maybe we could say that. Anyway, this thing has come back, and there's a lot of stocks out here that have this super high low volume highs, but they are slightly moving higher as we are right now at the high of the day and broke a new high of the day, 1673.63 as we speak. A little under 2.4 billion shares, but my guess is that this is pretty much the end of the option for lower prices this summer. We needed a close lower than the previous high, and we needed some kind of sign of weakness. Basically, we had a lot of people staring at each other for multiple months. Anyway, we've got a phone call from Bill in Portland. And how you doing today, Bill?
Oh, real good, David. I've got the Art of Timing the Trade software, and I would like maybe a little more explanation or find out if there's a source to read on your power vector. I guess you have proprietary principles in there, but, just an idea of kind of what it measures. And I guess the question I have is when you're looking, for instance, at a Tiger Long, do you like to have large values on up moves and smaller values on down moves? Or if you could just give me a little more explanation on how to use it.
Okay. As a background for those that don't know, it is a combination of three things. It is a combination of time, price, movement, and volume. Much like getting a charge for your electrical bill. If you have an AM radio on, the little wheel on the side of your house is not going to spin very fast. You're not using a lot of energy. You turn a day like today, 90 degrees, 100% humidity, that little wheel is going to spin real fast using the 220-volt power of your air conditioner. So the idea is try to figure out quickly, and something I can actually scan for, is finding what kind of energy came back in, how quickly it came back in, and what we're looking at. If are you watching Tiger TV now or the Den or anything?
I'm watching it. I don't know, for some reason on my screen all I'm getting is the banner with the advertise. Okay, I've got it now. It somehow came through for me. Okay, I'm looking at the chart.
You should see Angie's list up now.
Mm-hmm.
The idea is that normally this was what will happen into a move, and that is that you have a huge up move, and in this case, not a lot of ups and downs in it. We can add a few more legs out here to see. But what you end up normally getting is this. You get from the 1815 low of April 3rd, this thing juts up, and you can see it goes to super high volume high up here on April 25th. Pretty good idea that this thing's going to get tested. What you do get then, though, is this May 23rd leg starting at 2206 back up to the 2824 up here. So you get a real huge move, kind of short amount of time. A lot of energy comes into the market. It goes sideways for a while. Then you get this really low volume push back up. And if you actually wanted to talk about the kind of money, you can think of it as almost like a third less coming in. We'll try to answer the rest of this question after the break.
Thank you.
Hopefully you can hang in there, Bill.
I'll do that.
Okay.
With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter, Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
The power law vector indicator, just quickly here, but the what I'm showing on the screen right now is the EUO, which is the dollar Europe inverse short, or not inverse short, but just the short, ultra short. And this was one of the best looking Gartleys that has come along in a long time, especially in an ETF. But if you look between the X and the A point, it's a 1.9. If you look at the C to D point, it's about a 1.6. What you don't want to see is volume start coming back in or energy come back in, but you also want to look at what the volume was like as it went back through the C point and whether or not you're going to see this thing turn around at the 0.78 retracement. What you do have is not a bad-looking chart here. You've got a leg where the volume kind of pulled back, and what you really saw with the last 4 or 5 days before it got to the D point was a very light volume. But, you know, we had a 1.9, you have a 1.6, energy's less on the way back down, gives you exactly what you're looking for. I want to see energy come in, I want to see kind of a less energy in the A to B and B to C legs, then I want to see the volume, the stock pull back or the ETF pull back, and I want to see a lighter volume in here. Now, let's show another one here that I've been looking at, and that is soda. Now, if this thing was going to really take off, it's got a 30% short interest rate, and I was thinking, well, maybe this will be the kind of stock that really takes off in a market like today. But what a little bit more when you look at it, did you have a 3.5 on the way up from the X to A point? You had a 2.7, so it's kind of like the EUO trade, but with one major difference. At the B point, you had 1.6 million shares. This had almost 2 million shares as it went through the B point, and even yesterday it had 3.6 million shares. So the idea is to look at those power law vector indicator numbers, look and see that the volume and the trade is getting ready to turn around by seeing the energy mostly in one wave compared to another wave. Notice that it's coming down, and then start looking at the actual swing points. And as it breaks things like the B point, does volume come in? Does it get real light? And if you just look at those two examples, probably a pretty good idea that you want to see that volume come in lighter and the energy come in lighter, but at the same time you still have to look at the as it breaks through the B leg, as it comes back down, does volume really accelerate like it did a couple of days ago in soda, or on the other hand, is it actually building? And that's probably a good indication if we have a lot of people getting in and out of it. But these are just relative numbers. You want to look at the legs up and the legs down. And it just gives you a quick way of looking at it before you get real invested in some of the other methods of working with these. See, there's one more I wanted to look at. Now, if I can think about it. What is it? Soda. Well, does that answer your question, Bill, if you're still there?
I think so. Well, you say time, for instance. If in general, say you had the same volume and a characteristic and in a certain time and a certain price change, if the time was twice as long, what would that do to the power vector?
It would probably take, if it took the same length to go the same price, it would take probably about a fourth off of it.
Okay.
So without getting deep into the bowels of it, it's exactly the same way you get charged for electricity. Okay, if you run your air conditioner for twice as long, it's going to cost more. If you run your air conditioning half as long, it'll cost you, of course, half that much. But let's say we compare it to a radio that uses 1/5 of what your air conditioner, 1/10 what your air conditioner costs, and you put that back in. It's really not going to have that big of an effect on it. So really what we're looking for a lot of times is real big days when they come back in. Let me take a look. I wanted to see if I could think of any other good examples real close. And here's a good idea. SunPower, SPWR. We've been looking at some of these stocks come up to these previous highs on very light volume. What we see out here is that this came off the 23.76 high. It came down to the $17.77 low on June 3rd. Basically, you had a 5.1 in that. If you would have looked at this a few days ago, you would have had pretty much a similar movement up, which really meant that you hadn't had all the energy come out of this thing. If we would have seen a real low number, in fact, look at this. If you see the energy off that 1777 low, it popped up on 5.2, but then it came back on 3.5. It also tested that low on a lighter volume. So you see the energy come off the low. When it comes back, it does take more time, but at the same time, there's a whole lot less energy and volume comes back into it. It does break the previous low out here, but it is telling you a story that it came off the bottom with some energy. It came back on lighter energy. It did prove the point by testing the previous low on, well, what, about 1 million shares lighter, 5.2 million to 4.3 million. As soon as it closed back up, you could have bought this. The energy came back up to this high, but you really didn't see energy start to accelerate as it goes up into the previous high. So you probably would have, if you've been long this thing, you would have said, hey, it was time to get out when it broke the previous high on lighter volume. Mm-hmm. So in this case, you just kind of want, it's just like watching waves come in. Was the wave big? Was it small? Was the energy light? And mostly when you're going to see really great setups in the markets. Did Angie have it? ANGI. Let's take a quick look. I think here's a good example on Angie. What you wanted to see is energy actually came back fairly strongly from the April 25th high back into the May 8th low. You wanted to see at least probably the same kind of energy. This thing had a much longer move from May 23rd back up to where it actually broke the previous highs. But you had 7 million shares that day. So, you had everything you were looking for back here, which is a test of the previous low, went 13 cents below it. It did it on less than half of the volume. So, of course, now the stock starts moving back up. But as it moves up, was there ever really any energy compared to the April 25th high back down to the May 8th low? And the energy just never really came back into the stock. Mm-hmm. So, this thing, even longer with all the extra volume that came back in, it took some more time. But the energy actually going back up, the momentum never actually was as good as the momentum down off that first huge high at 26.72. So, was it that much less? It wasn't. But your real key was going over the previous highs, on 468,000 shares and 666,000 shares compared to the 7 million shares that happened. But it wasn't a surprise that when you got up there, the volume wasn't real good. Probably a surprise that it was less than, not even 10%. But probably, you would have seen or thought that you would have seen with that amount of time, with that amount of move, it should have been close to the 2.5. It was 2.2, and as you trickled around those highs, the volume was always very low as you were at the very top of that bar. So it's just one more tool to go back there and look at moves. But you want to say, okay, the move came, let's say this little move here from the $22.20 low to the 26.33 high on May 15th. You had it up, you had 1.8, down, you had 1.3. So if you just want to look at those as a ratio real quick, it went up on 1.8, came down on 1.3. Energy was off, about 25%. So pretty good indication that, or even more, 30%? Pretty good indication there wasn't a big push down and that you tested it on very light volume, closed back into the trading range. Pretty good indication that you were at a support level. So it didn't do much for about, 6, 7, 8 days, but then finally popped back up. But kind of a more complicated chart. I'll try to see if I can't find one that's a little clearer in the coming days. But does that give you kind of an idea?
Yeah, that's a great
You're looking
show.
at the move down, and this one, the move down came on 2.5. Not a big deal compared to the pop up. But the next move up, instead of 2.5, is 1.8. Doesn't even make the previous high because, of course, the energy just isn't there. But even then, it comes back down one more time. The energy is very light. It's if you wanted to look at that move, pretty much almost the same price range move, right? 2.5 to 1.3. The energy is about half coming back into that low. The low volume on that day is about half of what the previous volume low. Telling you a pretty good story that as this thing gets back to $22, the energy is almost always about half. Of course, then you move back up and nothing really comes of it that much. And you see the test of the highs on very light volume, good indication either one to short it or to get out if you're still long or still thinking long out here. But, probably the key would have been that day that you had 800,000 shares and it was the big candle, but you never got the big volume. But just watching one leg up, one leg down. But probably if we wanted to put it in a nutshell, is that May 8th low to the May 15th high, back to the May 23rd low. 1.8 up, 1.3 down. You look at the previous low compared to the previous low, volume's half. Pretty good indication that there's no energy on the way down. There's no energy when it got there, and it went ahead and bounced. So that's kind of just reading the waves. It's kind of a longer term value out there. So don't get too wrapped up about it when it gets just down to a couple of days. But over time, especially 7 to 21 days, it's very good at getting a good idea of just how much energy was in those legs.
The other thing I've wondered is there a range of values used to qualify a chart as a Gartley or a butterfly Gartley? You know, I see general patterns, but and some are included and some aren't. I didn't know if you had a certain qualifying
well, normally it's
the ideal.
The Gartley has become something of the eye of the beholder. We spent about a year arguing between, I wouldn't call it arguing, debating with Steve Rhodes, Tom O'Brien, Larry Pesavento, what became and what worked for what is a Gartley and what isn't. Part of it has to do with money management. Larry Pesavento will look at a wide variety of options and say, hey, this is a Gartley. The problem is that there's no way to trade some of those with proper money management, not that he is. But what we did was try to put together some values in Art of Timing the Trading Charts that would let you go back and trade these things with some level of money management, so we're not just looking at all kinds of patterns that no longer or wouldn't be tradable later, especially in equities. So basically what we're looking at is you want the X to A point to most likely be, well, it certainly can't exceed the X point to begin with. Let's go back to, what do we have? Let's go back to that EUO trade, so we'll look at that again real quick, because there is an answer to what you're talking about, and we'll kind of give the rough outline of it. You start with the X to A point, and that starts the Gartley, whatever that is. You want it to probably come back more than 50%, but probably less than 90%. And at that point, you want it to come back up and go higher, and most likely you want this thing to come back about 65%. In this example, it came back 86% between the A and B move. Okay, then you look at the C to D move, and you want the D move to actually come back in somewhere around the 78% of the X to A move. So what you're looking at is a lot of different patterns. There is an ideal. Did you watch the videos on the TFNN website?
Yes, I did. I guess I didn't get, from that, what would have qualified necessarily.
The answer is a lot qualifies. When you see these, though, that come very close in a standard 222 Gartley, that come back, and the final C to D leg, and the D point comes right in at that 7-8, that you get this kind of move back up at the top, somewhere between 50 and I would actually like a little less than this one came up. But you want to hang through the rest of the show with me?
I actually do have to go, but I really want to thank you for the help.
I'll try to answer some more of these questions before in the last segment here.
Okay, thank you so much.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try patterns, profits, and peace of mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's patterns, profits, and peace of mind.
And get the edge you've been looking for.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Nowhere, spelled N-O-W-H-E-R-E. At one point, we've all been there, whether it be our health, career, or our finances. Some might be there right now. So where are you when it comes to your trading and investing? Better yet, where would you like to be? The good news, I can take you from nowhere to now here right now. Same letters, N-O-W-H-E-R-E, just a totally different emphasis and focus. Hi, I'm Steve Rhodes with TFNN, and on July 25th at 6:30 p.m., I'm going to share with you a trading strategy that I began on May 10th when the S&P was at 1627 and closed at the same price 8 weeks later. That's right, the S&P went nowhere versus a trading strategy that produced 100% hypothetical return in that same period of time, and it's now here for you. Subscribers to my daily newsletter service, Mastering Probability, have free access to this exciting live workshop. The trend is your friend. All the details are on the homepage of TFNN.com. Decisions shape your destiny, and your trading destiny is now here for you.
Join Andy Hecht as he teaches you how to make money in commodities. The Commodities Hour, next on TFNN.
Yeah, I wanted to take a look and see if anything really happened. We had kind of a push here up to the highs of the day at 1674 now. Volume did not really come in. We've got 2.6 billion shares now, but that seems to be pretty much what a summer rally is about, and we can see this extend now pretty much all the way into the end of the year, as long as everybody believes that no matter what happens, no matter how bad the news gets, the Fed's going to throw more money into the market, and there's nothing in what Bernanke said yesterday that would lead, I think, anybody to think any differently. We've had 100 companies now come out in the S&P 500 and lower guidance going forward. I think the rest of them will probably be doing the same. Probably doesn't really mean too much in the way of the stock market. Today, what we really would need to see a big signal is a close back below 1656. Probably not a high probability of that happening now. We had a good chance earlier in the day for this thing. Maybe we do get a rollover in this market. Certainly don't have the volume to support this move in a normal market, but there may just be the belief, and perception is reality, that no matter what happens, the Fed is going to borrow more money, sell more treasuries, and that money is going to find its way back into the equity market. We do see some stocks that have had some blow-off tops. Kind of interesting in those, but maybe it's going to take another 3-6 months, or maybe in the case as we talked about in the open, late 2001, let's call it 2002, to May of 2008, when all the banks blew up. Bubbles can last an incredibly long time, and when you have somebody that can basically call up the Treasury and say, print me some more, the question is just how far is he going to go in? And I think yesterday the answer was all in. Sometimes when you get those kind of news, that kind of news, it is sell the news. And I thought there was a good chance today that we could have a sell-off before the end of the day, based on, well, if he has to go back in all in again, it can't be that great. The news can't be that good, and we're going to have to probably watch the last 30 minutes of the day to really figure out what's going on. We were talking about what makes a good Gartley. In the art of timing the trade charts, it is kind of a basic move out here that you want something set up so that you can get fairly decent money management out of it, and that you can get a profit. Now the question comes always back in, how far do you want it to come in? And theoretically, the B point can't be below the X point, that the C point can't be above the A point to actually make one. Now, does that make something you can really trade off of, or is that really just a test of the previous high and a test of the previous lows that just didn't bust it? And my guess would be, you really don't want anything that comes any farther back down at the D point than 90% of the original X to A point. So if it was $10 up in a move, you probably don't want it to come down any more than the A point minus $9. And some of this may be problematic. I actually put together some videos on the front page of TFNN, or on the, I think they're on the web page for the art of timing the trade charts, but they go back in there and I drew out the patterns. I'll try to get those patterns out and we'll go through them tomorrow. But anyway, some interesting movement out here. 20 points on the S&P cash, 2.6 billion shares, which is not a lot. We'll have to watch this market. We will be back tomorrow, same bat channel, same bat time. See you then.